Welcome to The Explainer. Today, we're diving into a genuinely fascinating corporate mystery at the intersection of high finance and sustainability. Ganesh Ecosphere Limited, or GEL, recently hit a pretty rough patch, experiencing a noticeable dip in their profit margins during the first half of financial year 2026. Now, normally, when margins drop like that, rating agencies start sounding the alarm, but Care Ratings? They stepped in and firmly reaffirmed GEL's rock-solid A+ credit rating. So why exactly does this high rating remain totally intact despite the sudden financial turbulence? Well, that is the exact mystery we're unpacking today.
Okay, let's dive into this. Here's our roadmap. 1, the A+ verdict. 2, driving the green growth. 3, the financial foundation. 4, headwinds and roadblocks. 5, the ESG advantage. And 6, looking ahead.
All right, Section 1, the A+ verdict. On January 6, 2026, the official word came down. Care Ratings explicitly reaffirmed Ganesh Ecosphere at Care A+ for their 180 crore rupee long-term bank facilities. And they didn't just reaffirm it, they kept the outlook as stable. Basically, the agency is signaling that despite some recent bumps in the road, this company's long-term trajectory is incredibly secure.
To really grasp why an agency would have that kind of confidence, we kind of need to step out of the financial weeds for a second and look at the physical reality of what GEL actually does. 7.5 billion. That's how many PET bottles Ganesh Ecosphere has recycled. This isn't some small startup testing a proof of concept. They are operating at a massive industrialized scale, processing over 125,000 metric tons of PET waste every single year.
Moving right along to Section 2, driving the green growth.
The secret sauce behind their dominance in the textile industry is a product called RPSF, or recycled polyester staple fiber. Basically, this is a synthetic fiber made directly from recycled PET chips, polyester waste, or, you guessed it, those billions of post-consumer PET bottles. GL is one of India's absolute leading players in RPSF, running a fully integrated operation across both fiber and yarn. And this brilliantly illustrates their entire business model. They are literally taking the packaging waste that clutters our environment and transforming it into highly valuable raw materials. These materials are then sold to massive B2B clients all over the place, from automobile OEMs to clothing and packaging manufacturers. Now, doing good for the planet is great, but it's also translating into massive financial growth. In financial year 2025, GEL's total operating income hit an eye-watering 1,464.85 crore rupees. That is roughly a 30% jump compared to the previous year. This huge surge was driven by incredible demand for recycled products, plus the successful ramp-up of their new subsidiary operations in South India and Nepal. Which brings us to Section 3, the financial foundation. Now, a credit rating is built on a lot more than just top-line revenue. Before we look at the numbers, you're going to hear me use the term PBILDT. That stands for Profit Before Interest, Lease Rentals, Depreciation, and Taxation. Honestly, just think of it as the raw engine power of the company. It's a key indicator of day-to-day operating performance, stripping away all the noise of taxes and accounting quirks. Now, what's really interesting about this is the sheer velocity of their growth, from March 2024 to March 2025. You see that 30% jump in operating income we just talked about? Well, look right below it. Their PBILDT, their operating profit, surged from 136.85 crore to over 210 crore rupees. And crucially, their overall gearing, which basically measures their debt relative to equity, stayed at a very comfortable 0.48 times. So they grew incredibly fast, but they didn't bet the farm to do it. How did they pull that off? Through a really smart, structured capital strategy. Step 1, they raised a ton of funds. 350 crore rupees through a qualified institutional placement, and about another 150 crore through preferential warrants. Step 2, they used a chunk of those proceeds to pay down existing debt. Step 3, they funded their new greenfield expansion projects. It's a textbook sequence that ensures a rock-solid liquidity position even when rapid growth demands more working capital.
Section 4, headwinds and roadblocks.
Okay, so they have immense scale, booming revenue, and a smart capital structure. Why did we start this explainer talking about a mystery and a profit dip? Well, this right here is what raised eyebrows. In FY25, GEL hit a very strong PBILDT margin of 14.35%, but in the first half of FY26, that margin dropped significantly, down to 9.49%. That is a noticeable contraction, and it's exactly the kind of thing a rating agency has to scrutinize. So, what caused the sudden drop? Care Ratings actually isolated three main culprits. First, raw material costs spiked because scrap was being heavily exported to Europe, though, to be fair, those prices did normalize in the second quarter. Second, there was a general slump in B2B demand. But third, and probably most importantly, the government issued a draft amendment to the plastic waste management rules in June 2025. This allowed companies to carry forward any shortfalls in using recycled plastics into the next year. That created instant market uncertainty and delayed the procurement of food-grade recycled PET. But the big takeaway for the rating agency? These are temporary external speed bumps, regulatory delays, and supply chain blips, not a structural flaw in the company itself.
Moving to Section 5, the ESG advantage.
When those temporary headwinds hit, a company really has to rely on its foundation. And for GEL, environmental, social, and governance, or ESG, factors act as a massive counterweight to short-term volatility. Look at their push for renewable energy. They've installed 16.53 megawatts of rooftop solar, and they purchase another 17.43 megawatts. Combined, that covers roughly 40% of their entire plant's energy demand using just renewables.
And it goes way beyond just solar power and recycling bottles. Their major facility in Warrnambool is actually a zero liquid discharge plant. They are actively recycling and reusing about 90% of their water. That means they only need to draw about 10% fresh water to operate. It completely insulates them from the environmental and regulatory risks that normally plague heavy manufacturing. Finally, Section 6, looking ahead. So, the crucial point is, what comes next? Care Ratings laid out a very specific roadmap. If GEL wants to trigger an actual rating upgrade, they need to push that PBILT margin back up beyond 14% on a sustained basis. They also need to grow their scale of operations past 1,650 crore rupees, and they need to consistently drive that overall gearing down below 0.30 times. But of course, there are tripwires on the other side too. To maintain balance, Care clearly listed what would cause a downgrade. If operations shrink below 1,000 crore rupees, or if that profit margin stays stuck below 9%, that A+ rating is in real jeopardy. Also, they're watching working capital closely. If the operating cycle stretches out past 150 days, it's going to hurt their liquidity. Which brings us to the biggest catalyst on the horizon, the final notification on those plastic waste management rules. The exact same rules that caused the market panic earlier this year is expected by January 2026. So the question is, will this final regulation be a lingering headwind, or will it lock in aggressive recycling targets and become the ultimate catalyst for this company's next massive growth phase? That is absolutely the space to watch. Thanks for joining me for this explainer, and keep learning.